Hello, hello everyone. Welcome back. Today we are going to be talking about PPE transactions. PPE stands for property, plant, and equipment, or fixed assets. Basically, what we're going to do is perform certain transactions that are related to those assets on the balance sheet that relates to, for example, buildings, equipment, furniture, and other non-current uh, assets. Remember, non-current assets, they are on the balance sheet on the asset sides, just below the current assets. And for one of the uh, characteristics is that you have to record depreciation, and in the balance sheet you will have cumulative depreciation as a contra asset. A contra asset is a deduction, or it is an amount that you will subtract from the original amount. In this type of assets, it will be uh, against the historical cost of the equipment. For purposes of this presentation, we will be working with two main transactions. One, retirement of PP&E, and sales of PP&E. Retirement is just basically plain and simple that you will not get anything in return. You just taking out, or you are uh, saying that the equipment doesn't has any value, or any it is not capable of doing anything with it. So if you completely depreciate a fixed asset, then when you retire, you will debit the accumulated depreciation, and you will credit the fixed asset account. Remember, uh, since every equipment has a um, accumulated depreciation account, you have to take them both out of the balance sheet. So let's do an example of a balance sheet. Let's say, for example, that you have an equipment with a depreciation, accumulated depreciation. Let's say, for example, 50,000. Let's put. Let me open this cell so it will look better. Okay, debit, credit. On the balance sheet, you will have 50,000 on the debit side. You will have 50,000 on equipment, and then on the credit side, you will have. Let me fix this. Since it is a balance sheet presentation, we don't need debit credit. So in the balance sheet, we will subtract equipment from the accumulated depreciation, and we will get a net equipment value of 0. The net equipment value of 0 basically is the book value. Remember, when you are working with equipment, you have to realize that what you're getting on the balance sheet is the book value. It is uh, a calculation, so it is not the fair value. So let me place that in. So book value is 0, but not necessarily is the same as the fair value. You could sell that equipment for any other amount, um, because sometimes all you have done is just allocated your cost, your historical cost, over a series of periods, and at the end, still the equipment, since it's usable, you can still sell it. So this is just for accounting purposes. This is for allocation of the cost over an extended period of time, but it could have some value, or its fair value could be way more than just the book value. So keep in mind that, because this is very important when you are valuing your equipment and expected cash flow in the future. But anyway, that's something else for another course. But as for what we want to do for this particular asset, since its book value is 0 and we want to retire it, our journal entry will be very simple. it will have we will just take we will not sell it. Just simply we will say that we were retiring the asset. So we will debit the accumulated depreciation account and we will credit the equipment. As simple as that. And basically what we're doing is reversing then the value that it has for book purposes. Let me place the debit and credit abbreviations. Accumulated depreciation is 50,000, equipment is 50,000, so we don't have any value to it, so it will be out of the balance sheet. It won't be in the balance sheet so anymore, since we have reversed the entry at the end. This entry will eliminate the equipment and the accumulated depreciation from the balance sheet, both, so it won't be anymore. So this is one of the entries that you have to keep in mind. Remember that fixed assets, they are buildings, property, fixtures, and it is except land. Land is not depreciable. There are other considerations, but none for this presentation. Let's go for the next example. Let's say, for example, that we want to sell. If we decide to sell an equipment with certain value, we will retire the equipment, but selling it. Let me place this information. I'm trying to type as much information as possible, so you will use it as a guide to understand what we are trying to do for equipment. Fixed asset is something that you need to know if you want to work in accounting, since this is one of the main assets of a business. Then if you sell before the end of the useful life, remember that you have to recognize either gain or loss on the sale. So let's do loss on disposal. Let's see how it looks like. Let me make some corrections here so I make sure that it is well written. And remember, if you like this video, please leave a comment, a thumbs up, and please subscribe. Let me copy the information that we had before, and let's do this. Accumulated depreciation 38,000. We have a book value of 12,000. Let me correct this. So basically we were saying that book value now is going to be $12,000, and not necessarily needs to be the same as the fair value, as we explained before. So now we have an equipment that it hasn't completed its useful life. So now we have to add some information to our journal entry. Remember, we are retiring this equipment. We are not getting anything, so we have a loss. So the accumulated depreciation will be 38,000 as before. Then we will debit a loss on disposals. Why a loss on disposal? Because we retired before the end of its useful life, and the book value of is $12,000. So basically what we have here is a debit loss, a loss for 12,000, and the equipment still we will credit it with the historical cost. Why the historical cost? Because in US accounting, GAAP accounting, historical cost is not modified. So you keep the asset on historical cost, and if you decide to retire before, then when you credit, you will credit the historical cost, and the loss will be included on the other expenses and losses in the income statement. The accumulated depreciation and the equipment will be part of the balance sheet, but since we are taking them out in the next presentation, they won't be there, but the loss will be part of the income statement and in the other expenses and losses side. Let's do a third example. We will sell of equipment. Let's say now that we will sell it for a gain. Let me put the information. So we'll set up like, if the sales is larger than the book value, then you will get a gain. If we have the book value is larger than the sales is larger than the book value, then you will get a loss. So it is important, the book value is larger than the sales, then you will get a loss. So this is very important to understand. So we make sure that we want to have the information to make sure that we properly classify our transaction. So we want to make sure that we get the book value correctly at the date of the sale, meaning and this is something that I'm going to add for this example. I'm going to use let me put a new data for this example, and I will throw in a new variable, so make sure that you understand this. Let's say, for example, that we have equipment that its cost is $36,000 and the accumulated depreciation is $24,000. So we have useful life, let's say, for example, of 3 years. Just to make it very simple, our calculation, this is for illustration purposes, and on March 1st of 2018 we will sell it. We will sell this equipment for, let's say $15,000. Let me add, okay, let me put it in this cell. So we have $15,000, and the accumulated depreciation, we will say that it is as of January 1st. So we have a mismatch of dates. The report date says accumulated depreciation January 1st, and the sale, we sold it on March 1st. So we need to take care, we have 2 months that we need to take care of it. So let's do some simple math calculation to make sure that we have set up everything correctly. So again, let's have the cost $36,000. The useful life is let's convert that to months. So it will be 3 years times 12. It will be 36. So the depreciation expense on a monthly basis, it will be 36,000 divided by 36, and we will have 1,000. That will be our expense on a monthly basis. So that makes us very a simple example of what we want. So for example, we have January 1st as our accumulated depreciation 24. So we need to make sure that we record, or we make a transaction for January and February, just to make sure that we have our accumulated depreciation at the date of the sale. So what we need to do is we have to record, make a journal entry for those 2 months. And since there is 2 months, it will be 1,000 times 2 months, January, February. So it will be a total depreciation of 2,000. So we need to make a journal entry for that. So the journal entry will look very simple, the one that you already know, and that will be depreciation expense 2,000 on the debit side, and you will have accumulated depreciation 2,000 on the credit side. Remember, the depreciation expense is an expense, and it will be in the income statement. The accumulated depreciation is a contra asset, and it will be on the non-current side of the fixed asset, it will be part of a decreasing number on the equipment, PP&E. So we have already set up the accumulated depreciation. So now let's solve this example. So again, we have the cost 36,000. Now we have accumulated depreciation that we have already updated. So we have our accumulated depreciation being the 24,000 that we had originally. Let me take that 20 and we will add the 2,000 that we have already we calculated. So now our book value goes to 36 less 26,000. So we have 10,000. So now we have a book value of 10. Let me clean up this so it will look good. Let me put a nice line so it will make sense. And we have a sales price of 15,000. We have that already. So now if we subtract, let me place the line underneath, and if we subtract the 10,000 book value and the sales price, it will give us a 5,000 gain on disposal or on sale of a PP&E. So now we're ready to put together a journal entry to show how it will look this. Since the sales price is larger than book value, then we have a gain. So here's our number, $5,000. So what exactly we need to do now? Well, very simple. We only need to do is a journal entry, and we will do this second journal entry to solve this issue. The first thing that you receive is cash. You get cash. You have to eliminate the accumulated depreciation, which is a contra asset of the fixed asset. Then you have to eliminate the equipment, and you have to record the gain on disposal because you decided to sell your PP&E. So let's put together the amounts and see if we got it correctly. Cash, we got $15,000. Accumulated depreciation, it is 26. The equipment, the original cost, the historical cost is 36,000. Remember that. Always you will take out the historical cost, and then you will get the 5,000 gain on sale. Let's add up the debit side and let's add up the credit side. Let me correct this formula for a second. Let me correct it, and you will see debits equal credits. One of the things that I have told you before is that when you are doing accounting, you want to make sure that debits equal credits. That is a basic part of the accounting formula, which is assets equal liabilities plus owner's equity. So that is something that it is very important. One of my videos I explained that part to make sure that you do understand and you're capable of solving those kind of questions on your accounting courses, or if you want to analyze that. The resulting gain is presented on the other revenues and gains section of the income statement. Remember that. So when you are working with this, you want to make sure that when you are journalizing your entries, you need to make sure that you are putting together everything in the correct side. So let me copy all this information here. Let me copy this for the next example. Let's work another and last example, but it's going to be a faster one because we have already set up everything. So all we need to do is correct some amounts, and let's do this. Let's say that we have a loss, and let's say, for example, that we will sell it for less. We will sell it only for $7,000. but the same condition remain. So we have already set up that we have 10,000 book value, the sales price is 7,000. This time we will have a loss on the disposal of 3,000. Why? Because our sales price is less than the book value. This is very important. Let me correct this part. The sales price is less than the book value, and that's why we have a loss. And let's correct the other part, which is a journal entry. We want to make sure that we have the correct amounts and in the correct place. First, we got 7,000 for cash. Accumulated depreciation stayed the same, 26,000. The equipment, the historical cost is 36,000. So we have pretty much everything set up, but we have to take care of the gain on disposal that we had before. We need to eliminate the gain on disposal, and we have to include there a loss on disposal of the PP&E, which is a debit side. Losses, they are recorded on the accounting books as a debit, and we will have that as a 3,000. Oops, I got the calculator on, but we don't need that except we take care of everything. So we will have 3,000 as a loss as a debit side. We will eliminate this, and let me plug in so we got our formula right, and let me correct this so it will add up correctly. So we have that 36,000 on the debit side, 36 on the credit side. Let me move this in a way that it will be correct and it will be well presented. We have the debits together and the credit. Let me correct the formula so we make sure that it is set up correctly, and both debits equal credits, and the resulting loss, it will be shown in the loss in the other expenses and losses. Please keep in mind, if you like this video, please subscribe, please give a thumbs up. If you have a question or suggestions, please comment and let me know if you need any help. I will be glad to put another video to give you any ideas. Thank you. Bye bye.